Hey there, future investors. Today, we're diving into the world of mutual funds and ETFs, two popular investment options that can help you grow your wealth without needing a PhD in finance. So, if you've ever felt overwhelmed by the stock market or simply want to make your money work for you, stick around. We're going to break it down in a way that's easy to understand, relatable, and even a bit fun. Let's start with mutual funds. Imagine you and a group of friends decide to pool your money together to buy a bunch of different snacks for a movie night. Instead of each person buying their own chips, popcorn, and candy, you all contribute a little bit of cash, and one person takes charge of buying a variety of snacks. This way, everyone gets to enjoy a little bit of everything without breaking the bank. That's pretty much how mutual funds work. In a mutual fund, many investors combine their money to create a large pool of funds. A professional manager then invests this money in a diversified portfolio of stocks, bonds, or other securities. This means your money is spread across various investments, which can help reduce risk. Think of it as a safety net. If one snack goes stale or one investment doesn't perform well, you've still got plenty of other delicious options to munch on. Now, let's talk about how mutual funds are structured. When you invest in a mutual fund, you buy shares of that fund. The value of your shares goes up or down based on the performance of the underlying investments. Mutual funds are usually actively managed, meaning the manager is constantly buying and selling assets to try and achieve the best returns. However, this also means you might pay higher fees because you're essentially hiring someone to manage your money. But here's the kicker. There are also index funds, which are a type of mutual fund that passively track a specific market index, like the S&P 500. Instead of trying to beat the market, they aim to match its performance. Since there's less active management involved, index funds typically come with lower fees. If you're just starting out and want a simple, cost-effective way to invest, index funds might be your best friend. Now, let's switch gears and talk about ETFs, or exchange-traded funds. Think of an ETF like a mutual fund's cool, trendy cousin. They're similar in that they pool money from many investors to buy a basket of different assets, but there are some key differences that make ETFs stand out. First off, ETFs trade on stock exchanges just like individual stocks. This means you can buy and sell them throughout the trading day at market prices, which can fluctuate. If you're the type who likes to keep an eye on the market and make quick moves, ETFs might be more your speed. Plus, because they're often passively managed, many ETFs have lower fees compared to actively managed mutual funds. Let's also talk about transparency. When you invest in an ETF, you can see exactly what's in it at any given time. Most ETFs disclose their holdings daily, so you know exactly what you're investing in. With mutual funds, you typically get this information only once a quarter. If you're the kind of person who likes to know where your money is going, ETFs provide that peace of mind. But wait, there's more. ETFs come in all shapes and sizes. There are sector ETFs that focus on specific industries, like technology or healthcare, and even international ETFs that let you invest in markets around the world. This means you can tailor your investments to match your interests or beliefs. Want to invest in renewable energy? There's an ETF for that. Interested in companies that promote diversity? Yep, you guessed it. There's an ETF for that too. Now, let's talk about the downsides. While both mutual funds and ETFs have their perks, they also come with some challenges. For mutual funds, the fees can eat into your returns, especially if you're investing in actively managed funds. It's essential to read the fine print and understand what you're paying for. After all, you wouldn't want to pay a premium for stale popcorn at movie night. As for ETFs, while they're generally more cost-effective, the trading fees can add up, especially if you're buying and selling frequently. It's important to consider your investment strategy and how often you plan to trade. So, how do you decide between mutual funds and ETFs? Well, it really comes down to your personal preference and investment goals. If you're looking for a hands-off approach and prefer the idea of a professional manager making decisions for you, mutual funds might be the way to go. On the other hand, if you want more control over your investments and enjoy the flexibility of trading throughout the day, ETFs could be your best bet. One last thing to keep in mind is the importance of diversification. Whether you choose mutual funds, ETFs, or a mix of both, spreading your investments across different asset classes can help reduce risk. It's like ensuring you have a variety of snacks at your movie night. Nobody wants to be stuck with just one flavor. In conclusion, mutual funds and ETFs are both fantastic options for new investors looking to grow their wealth. They offer a way to invest in a diversified portfolio without having to pick individual stocks, which can be intimidating. Remember, investing doesn't have to be complicated or stressful. By understanding the basics of these investment vehicles, you can take confident steps toward building your financial future. So, whether you're munching on popcorn or crunching numbers, just know that you're on the right track. With a little research and the right tools, you can navigate the world of investing with ease. Happy investing, and may your financial journey be as exciting as a blockbuster movie night.